Hi, Warriors. Who's ready to exploit the consumer pain index with me today? I hope everyone here,
I
everyone
am
watching. I know
Me.
Blake's the exploiter,
Aloha.
and Ryan, decent call about the pound, maybe just that being a one-day wonder. My best idea is to look to buy the Dixie around 102.5. I'm going to start there, wrong on a close, say under 102. So that's my best idea, and I like the fact that I could do it on the day when the euro is weaker than the pound. And euro, I don't know, around 830 or so, 108.30, 108.5, if offered, is a sell. That's my idea. And Ryan, how about you?
Yeah, I'm going to look at dollar China. I think I'm going to stick with that one. Looking
Okay,
for a decent dip there.
To buy it?
Yeah, to buy it. Yeah.
Yeah, it's been pretty strong.
It's non-stop going up, so you've got to look at dips.
Yeah. Okay. Stelios.
Hello.
Best idea.
I have an idea for both outcomes. So if I want to play a dollar short, so basically if the CPI comes in weak, I'm going to look at dollar CAD, which is really close still to that ascending trend line. And remember, Bank of Canada hiked unexpectedly, etc. So I'm basically looking at things that are close to breaking out or breaking down. So dollar CAD short, if we get a weak print, it's going to break, and I think it's going to keep going. Obviously, this is not for a medium-term trade. This is just reacting to the reaction. On the other hand, if it's a strong print, then I think against all my natural instincts, I think being short gold is not a bad trade, because that's also relatively close to the lows, 1935. 1935, and you know how metals crash when the dollar rallies. Sorry. Oh, I thought somebody said something.
Okay.
So yeah.
Do you think we could trade 1980 first?
Go down, and there's no way it's going to I mean, if it's going to hit 1980, 1985, that means that the print is not good. It's low. So these are my two scenarios, sell dollar CAD on a strong print, on a weak print, and sell gold on a strong one for a short-term trade.
Okay. And K-Man, maybe you already have it on what you're looking to do.
Well, yeah, I am long dollar China. Managed my position a little bit into the CPI. Yeah, I may add on a stronger print. The one that I'm looking at on a weaker print, a really weak print, is cable. I think cable explodes if that's the direction. If we get a real sticky one, then I think dollar yen 140 is toast. I'm really ready for both outcomes, but I have a bit of a punt on via options for a higher dollar in dollar yen and euro dollar, a bit lower. That's just because I didn't want to cash. I just bought a few chips.
Okay, fair enough. And Steve, I know you're not like a big one for reacting to numbers. You're more of a have more of a position mentality. Any advice to people watching us today to keep them out of trouble? What would you tell them not to do?
Don't lose money.
I would definitely tell them not to gamble, right? And assuming that you're going to predict what the number is going to be and the reaction is in the sphere of gambling, in my opinion.
Yeah,
it's a different story if you have a position in advance that you intend to keep by managing it. That's a different story, right? But taking a position just a few hours or a day before any important print and hoping that the print is going to move the market in your direction is a very, very lousy idea. In my opinion. As I've said before, I think that we have several markets that are nicely positioned, having to do with risk reward in favor of an outcome that's going to benefit the dollar. That doesn't mean that this has any predictive power about what the outcome is going to be, right? I'm just saying, and we showed that yesterday on the morning edge, that there are several markets that are nicely positioned in case that's the outcome we get.
Okay. So Blake, I know you showed that harmonic pattern that could take us up to 4,400.
Yep.
There were a lot of people looking at 4,340 months ago. I've interviewed guys that said that's where we're going. They're calling this a flat in the S&Ps, going back to where we were, I think, in August. What do you think of this wedge pattern here? Will we have a throw over? And if it closes back inside, would that be a sign to you that maybe 4,400 is off the table?
Yeah, I mean, it would make sense just because, you know, we've gone far enough to squeeze out all the shorts. We've gone far enough to get, I don't know if you guys listen to CNBC or Bloomberg or whatever, but, you know, Tom Lee from Fundstrat is just talking about, you know, cyclical strength and, you know, it's got a lot of bulls in the bull camp right now. So we've moved to a point where it's gotten a lot of people in and gotten a lot of people, you know, the shorts out. So could it reverse here and just completely derail everybody? I mean, look, we got sentiment like DSI for the NASDAQ is at 91. That's an extreme number. It's an extreme reading. We got VIX at like 9. We've got like extreme sentiment going, you know, the direction of the bulls, which is a risk now if you're a bull. So I mean, I have a lot of I'll show you real quick. I got a lot of
one thing about the VIX yesterday. It was up pretty good with the market exploding to the upside. I haven't seen that in a while.
I have to remind people, and actually we had one of our traders, Nick, in our chat room here, just so you guys can see, like he was in the chat room yesterday talking about, this is our chat room, by the way, guys. Look, you can see it's obviously
Mel Gibson's in there.
Yeah, Mel Gibson's in here. I think Nick was asking yesterday about volatility, and the thing that he was talking about is that, or he's like, well, volatility is up and the market's rallying, and I'm like, well, higher volatility doesn't necessarily equate to lower prices. It's, you know, we are going to get an increase in volatility regardless. I think the what we have to be looking for is if the VIX is up like north of 8-10% today, that's going to equate to stocks being down. VIX is probably going to be up multiple percent today following the CPI regardless. You know what I mean? Regardless of what happens.
So no matter what, people are starting to buy protection. It's never been cheaper.
Yeah, I mean, and I think that just the take up in the moves that we see in the markets are gonna create an uptick in volatility. But what I wanted to point out with the S&P, you know, you were just saying 4,350. We're in the middle of like in between fibs, like this 127% Fibonacci extension. Then we have the 161% extension, which is the one that would be 4,450, 4,460, actually, or it's 4,436, excuse me. That is the target that I would think that we're going to reach for, but we have the bull flag target that stops just shy of that, around 4,200 or 4,400, excuse me. So, and we're pretty overbought. You know, relative strength is overbought. Even on a daily indicator, we're, you know, reaching for overboughtness. And like I said on the week ahead video, overbought can become more overbought, could be overboughtness, could be overboughterness, envy, or, you know, whatever you want to call it, it can be that way. So don't, you know, just because it's overbought doesn't mean it can't become more overbought. That's the point I'm trying to make. The fact is that we continue to break out, and I think you know, this data that we get today, the only thing could possibly turn us back below 4,300 is a stronger than expected print, right? And that's it. So Yeah. Hey, let's ask Ryan, you know, and Stelios and K-Man on the Flow Show. Well, first of all, hold on. I gotta say something. K-Man, you said, you know, the sterling. This is, you know, on the week ahead video, I mentioned that if the dollar weakens, cables held up really well. And we bounced off 125 like a bat out of hell that we talked about yesterday. We talked about the failure at 126, buyers coming in at 125. If you were on the ForexAnalytix, you know, Morning Edge show, that's exactly what happened. And we bounced again really aggressively because the UK jobs data was really strong. And I know you guys have seen it, but for those of us in North America, I don't know if you've seen, you know, yields, gilt yields, they ripped. And there, look at short term, or the you know, I mean, you can just see yields are just screaming higher. I mean, the cable's a buy. If we have weak data and the stock market rips and the dollar sinks, I think this cable is gonna, you know, break above resistance, and we're gonna be, you know, testing these highs. I know, K-Man, you just mentioned that. What do you think there?
Yeah, totally. I think that on a very weak print, it's one of my main focus pairs on is the cable for today. I think we could go quite a bit higher if really it comes in weaker than expected on the CPI, because it's already bid versus all the other currencies as well, and no, that's really a candidate for going higher if the CPI comes in lower.
Yeah, this is you know, go ahead.
Sorry, and if it comes in mild, slightly below, without really frapping the bed, then I think sterling crosses will be doing well at all, because that's going to be good for risk, right?
Oh yeah, and I would agree with that as well. This is going to be my favorite one. Well, not my favorite one, actually. I'd take that back. But the cable, if we have some dollar weakness that comes through, CPI data does, you know, disappoint. Well, let me define disappoint. It'll disappoint the bulls, but it would be good for consumers and good for the market. Hey, stocks would rally, cable's going to move higher, and the Aussie's probably going to continue to move higher. We're in an ascending wedge, but we could break out of these highs. With the PBOC, they adjusted not their midterm lending facility rates, but I forget which rate that they did adjust overnight. Ryan, which one did they adjust? Do you remember? You guys have probably been talking about it this morning.
It was just one of their overnight repo rates to 1.
Repo rate. That's right.
Yeah, to 1.9 from 2%. Just a small marginal change, but it's part of all these little changes. You know, we have more banks reducing the rate they pay on deposits, talk about banks reducing lending rates. It's all easing, and they're continuing basically to keep easing and easing. It's all bit part stuff though. You know, it's nothing huge. You're not cutting rates by 25, 50 pips or anything like that. But it's just all part and parcel that they're still on an easing path.
Yeah, that Archibald said the medium-term lending rate. That's going to be they're making a decision on that, I believe, on Thursday, if I'm not mistaken, or Friday morning or whatever it is.
I think if Aussie takes out those highs, Blake cleans out the stops over the prior high. 16,
yeah, and
20.
you know, we're above the 200-day moving average. A lot of that's you know, we're going to get back towards that neckline of the previous head and shoulder pattern from way back when. So
I'd short it there.
Yeah, I mean, you know, I think well, you have to imagine if we're trading up here at 85, or I'm sorry, 85, excuse me. It's still early in the morning for us, Dale. At 68.60, if we make it up to those levels, that means probably the S&P is closer to 44.50. You know what I mean? So yeah, I think it's entirely possible that we reach for those levels based on where really strong moves. So I also wanted to say that the dollar yen and K-Man's has just mentioned this. He's prepared for a higher dollar through the dollar yen. The dollar yen is just poised for a breakout. This is the breakout of breakouts that are probably going to happen today. following CPI. If you guys don't know the breakout points, this is the triangle we've been following, here at ForexAnalytix since last week. It is 139 and 140. Basically, a break above 140 is bullish. A break below 139, we're going to test 138, which is a key breakout point. You can see it right here. I think it's anybody's guess. Just like, is the CPI going to be stronger or weaker today? And how's the market going to react? It's anybody's guess today. But I think your levels are defined, and that's the most important thing as a trader, is identifying what those levels are, seeing where they're at, and knowing how to play them. And I think this one is very, very well set up. Speaking of another setup, the euro finally hit the 38% retracement, or the flag top, and it hit it last night. Now, this is going to be my play du jour on a strong dollar move. I mean, if we get inflation that has people thinking that the Fed might have to do something tomorrow, that is entirely possible. And if we see that, I think the euro's a great short, because the bounces have been shallow. And I know I've talked a lot about this. I even did a YouTube short on it yesterday on the ForexAnalytix YouTube channel, if you guys didn't catch it. It went right to 108.10, right where you would expect it to stop. It went to 108.10 and 0.8 of a pip and reverse. So it, went right to where it should have, anyway. So I think this is going to be my favorite setup on dollar strength, because even if we get a strong data print, we get a strong CPI print, it's going to, by the time you could get into it, realistically, it's going to be trading down at 107.50, right? Because unless you're just getting ahead of it and you're going to stick your neck out right now and get into a trade, which some people might do. But if you don't do that and you wait for the data to release, it's probably going to be a bit of time before we can actually get in. But still, even if you get in here, your risk is here, your reward is somewhere down here, you still have a good risk reward in this setup, in my opinion. So that, I think, is going to be a good, good trade on strong dollar data. So let's go around the horn and let's figure out what everybody's expecting and what data we're looking for. So we finally got the we're getting to the data that could possibly move the market. I think anybody that's been trading FX has been kind of quiet. We've been waiting for today, finally, so it's here. So what's going to be the numbers that moves the needle? And let's start with the guys that were on the Flow show first. Stelios, when you're looking at the CPI data, what's going to be the number that you're looking at that you think is going to move the needle?
Well, people usually look at the headline CPI number, but as Ryan has said repeatedly, the core number is probably more important because it excludes the volatile items and it's been a lot more sticky. So I think both are important, equally important for me. And what do I expect? Well, I've said before, I think that for me, most likely we see a slight under prints, slightly under the expectations. So, maybe for this, people calling for a 3 handle, I wouldn't be surprised to see that. The problem is core. Core needs to start coming down, although there are more and more rumors about the Fed moving the inflation target higher, but that doesn't change the fact that inflation is quite sticky in the core.
Okay, so you think that we should be looking at the core number, and it's still going to be a little weaker than expected.
I think so. That's what the Fed is waiting to see to say, right, okay, we're getting there. They want to see core come down. That's the thing.
Right.
Headline will go to 3%, as I've said a while ago, and people probably thought I was crazy. But core is the one that they really want to see coming down further.
Ryan, which one are you going to be looking at, and what matters to you today?
Just before that, China's actually cut rates. They've cut their overnight, 7-day and 1 month rates by 10 pips each. So
just now. Oh,
just now.
Just now. Wow. Yeah. Okay. Let's.
So 10 pip cuts again from some of their rates again.
Interesting. Okay. Yeah. And you probably hold on really quick. You'll see it right here on the live squawk feed. You can see it right here. Wow. Interesting. So what do you make of that instant reaction to that?
Not a lot really. $1's lifted up, well, I don't know, 100 pips or so. But as we said this morning, it was expected. They've been flagging this, and they've been pretty strong. It's no surprise that they've done this. Another 10 pips after last night's 10 pips. So yeah.
Well, they only have like 190 more 10 pips to go, and then we'll be at zero.
You want to watch out for the Aussie dollar if they cut the RRR, because that's the one that can suddenly move, 30, 40 pips on a RRR headline.
All right. Well, okay. Very good.
Back to the CPI stuff. Same as Stelios, really. It's going to be about the core. The core is more important than the headline number. But you got to take them all together. If the core comes in higher than expected, higher than last month, that's going to be the most hawkish outcome, and we'll see Fed repricing for a hike tomorrow. Let me ask you really quick. I'm going to interrupt you just for a second. If let's say the core number, the month over month number comes in, let's just say, using your example, comes in 0.5%, and people go, oh, wow, that's hot. Do you think it's really going to affect the Fed tomorrow? Well, I tend to stick with the year-on-year numbers. That's the one. So, if the year-on-year core is expected at 5.3 from 5.5 prior, if it comes in 5.4, that'll be hawkish. 5.5 hawkish. If it comes in above that, it's going to be super hawkish. It's like I always say, you've got to know which way the market's leaning into an event, because then you know where the bigger price risk is. If it comes in as expected on all accounts, we may get a little bit of dollar selling, a little move lower in yields, but the market is leaning that way. So the bigger price move is if the numbers are much, much hotter than what's expected or previously, because the market is then going to flip into pricing a hike for tomorrow, and that could be really volatile.
Got it. Okay. All right. Thank you. K-Man, what are your thoughts here as far as the data goes? Which data point are you going to be looking at, and why, and why does that matter?
Well, the core, because that's what the Fed is watching, and it's going to be interesting. The core is one thing, but if you would imagine the headline dropping below 4, I think it would be a bit of a shock to the system as well, on to the other side, to the weak side.
Yeah.
And
we got a 3 print,
you're going
to
handle. See the dollar really suffer quite a bit.
Yeah. Okay. And you and when you're talking about the dollar, your focus has really been on the dollar yen, and so, but the cable, I guess you were talking about today.
A little negative euro.
Yeah, a little negative euro, I guess. All right.
Yeah.
I'm a little everything right now, man.
Aren't we all? It seems like we all are. It's like
the key to me is always to find where's the weak link on the one and the other side of the market. So I think if we get a very mild number, it's going to be pretty good for risk. And stuff like sterling yen, for instance, even if the dollar yen goes down, we still have Bank of Japan at the end of the week. We had better numbers out of the UK, so perhaps sterling yen is poised for a move higher if we get a mild number, not a completely drop out of bed, but just a mild enough number to keep risk going. If you get a very hot number, I'm also keeping an eye on what's happening in the dollar rand, because I think 1850 is interesting. So if we start to hold that, and perhaps it's worth keeping an eye on the rand as well. I've got my eye on a few things.
Okay, very good.
He's a little bit country and a little bit rock and roll.
Rock and roll, yeah, exactly. That's right, Dale. Hey, I know Stelios mentioned this already about the 133 level and the dollar CAD. Let's not forget that this is a huge level that he's talking about. That's right here. Above 134, we get a squeeze. Below 133, you probably see a little bit of a shakeout ahead of tomorrow for sure. So just wanted to make sure that everybody sees this, what a big level of support is. So Steve, which way are you leaning as far as inflation goes? Do you think that we're going to have overall stickier inflation Because if I remember correctly, that's kind of your assessment for, you know, from a macro point of view, is that inflation is going to remain very sticky for a long period of time, or do you think we're going to continue to see these disinflationary pressures hang around? What are your thoughts?
Historically speaking, there is no precedence of inflation going this high and going away easily or fast, right? So that's one thing we have to take into account. Now,
but COVID happens, pandemics happen like every, you know, few years. So this is like, are we in unprecedented times?
Yeah, although I need to reiterate here that COVID is not what created inflation, and I think nobody in the right mind assumes this. The response to yes, the response to COVID is what created all this inflation.
Sure. That's what I meant. You know.
Yeah. No. I know. But a lot of people that listen in might, you know, not realize exactly what you meant. That's why I know exactly what you meant.
Yeah, got
it. My assumption is that inflation is going to remain sticky for much longer than people assume. Now, that doesn't mean that we won't see a steady pullback in this inflation, because we know that other factors that are important, demographic factors, etc., are disinflationary in nature. Plus the fact, as I've said multiple times, unfortunately, we do not measure inflation in an honest way, and that makes it a lot easier to show a much better situation in inflation than reality is. I don't think that inflation was just 10% during the past couple of years, and I don't think inflation is around 4% at the moment. Right? I've explained multiple times in other shows how exactly and with which methods the government understates inflation in the way they measure it. In any case, I don't think it's easy to make assumptions on a number-to-number basis. So it's a futile exercise to try to assume what the number is going to come out today. I did show a number of markets yesterday, though, explaining why I do think that in a higher number, which is probably going to produce a dollar positive reaction, is going to be, technically speaking, a better outcome in how some markets that are at pivot points can move from here.
All right. Thank you, Steve. We got about 2 minutes. I would really appreciate that. And your thought process behind, you know, inflationary pressures. And I tend to agree with you. I think we're in obviously unprecedented times that we all live in.
I have some sinus pressure going down today.
Yeah, you know, hey, here's the thing. I have to make sure that everybody's watching, which I'm not going to have on the screen during the releases. I gotta say gold. This is, you know, during the week ahead video, I made a big stink about this 1930 to 1985. That's really gonna, if you're a currency trader, you got to use that to help you understand, you know, if you're on the, you know, if you want to stick around with the dollar trade or not, if you're trading dollars, because you're going to see an inverse relationship and you're going to see it move relative to yields as well. So when gold's moving, just keep that in mind, that it should be reflecting or at least complementing what you're doing in the FX market. But like I said, we're going to be focused on what's happening in the dollar here. So let's pull up everything. Here's a dollar and the 15-minute chart. We've got 30 seconds. Here's the S&P right in the middle. Then you got yields over here to the right. Let me grab the, oh shoot, I didn't grab it in time. I deleted it for whatever reason. So let me get the data flash. Let me move that out of the way, put it back over here. There's your data flash. And the data is about ready to be released. Stand by. Here we go.
Release the Kraken.
Come on. I can actually feel your sweaty palms right now. You guys,
thank you.
I can feel them all.
Okay, let's go. I don't see it. Oh, in line. Headline is 4.
Ooh, dollar
is as expected. So theoretically, this should be a non-event.
It really is. I mean, look at the S&P, just kind of, well, that means
look
carry
at
on. Stock should rally.
Look at gold and silver.
Yeah, stock should rally. Yep. That's because nothing is going to change with anything that we see there. Nothing's going to change the Fed's mind. They're going to. What's that?
That's annoying. I wanted a nice big outlier number.
I know.
Yeah, that would have been nice.
You know what? This is going to open up the door for 4,400 in the S&P, get us everybody nice and bullish. The euro traded above highs. We've got the dollar yen trading down towards 139. Cables reaching for that 126. Now the question is, are we going to be able to make a break? And I think it's going to come down to the squeeze, right? Like, how much pain do bears take? How much pain do stock market bears take where they just throw in the towel today? Or, dollar bulls, they're like, screw it, I have to just get out of everything, I think we'll I mean, look at the
selling euro here.
Huh?
Selling euro.
You are? All right.
Yeah. Oh, brave man.
You are a brave man.
I have to say
that do my opposite of that right now.
I have to
fade me, man. I don't care.
I have to say that my intuition is that Dale might be right.
If it goes to 50, I'll sell another.
All right. Well, there you go.
All right. Okay.
All right.
So well, I hope we helped everyone today.
Yes, absolutely. And I want to say, guys, just make sure you check out ForexAnalytix. Come jump in our community. This is what our community looks like. And, these are the headlines that you're being talked about. We have S&P room, trades room, news and research room. We have everything here. And check out the trader funding program when you get a chance as well. So
yeah, yields are, watch the 360 level in bonds. I don't know if it'll be in play today. I'm talking about yields, 10-year yields. Under 360 opens the door to 330. Under 330, we're going to be looking at under a 3 handle in the 10-year. So,
all right.
That's one. And I guess it's time for welcome to today's interview on the ForexAnalytix community experience. And today's guest is Okan Abar. Welcome back to the show, Okan. How are you, buddy? I'm going to ask you to unmute. Should have done that before. How about now?
Okay. Sorry, I apologize.
Okay.
Thank you, Dale. Thank you very much.
Welcome back.
Thank you.
So, does this number mean anything to you? Were you paying attention to this CPI for market action today?
Well, as long as CPI data comes strong, the Federal Reserve is not going to going to stop raising interest rates. So that seems to me a little bit dollar
friendly,
positive. Yeah. And however, I should note that I recommend traders to look at the break-even rates for the dollar.
Did you bring any visuals that you want to share your screen with?
Yes, I have. If you want, since I just spoke about the break-evens, can I share with you?
Yeah.
Sure. Hold on.
It's that green button at the bottom. Here we go.
Okay.
Looking at your screen.
Okay. What I'm doing right now is bringing up the break-even interest rate. The break-even rates between the euro zone and the dollar. The US.
Okay.
As you can see on this chart, that very lately, in the US, the break-even rates in the US has been rising against the break-even rates in the Eurozone. This means that the potential of interest rates to protect investors against inflation or expected inflation is diminishing. And that is the reason why, as you can see, as this chart is increasing, the euro dollar pair is increasing too. So this chart is, I mean, this spread between the break even in the US and in the Eurozone is very decisive in that nowadays, lately, the central banks are focusing on the raising the interest rates. So with this respect, as long as whichever central bank increases the interest rates, its currency appreciates.
So let me ask you this: on the bottom, the yellow is
Let me
Euro
tell you.
US dollar, because it looks like it was a more higher magnitude move to the upside in the yellow than currently in the blue. So am
Yes,
I reading that?
yes, exactly. This means, for example, looking at this very recent rise, if you see this one,
Yeah,
this one is, as you see, this is
started
actually,
first. Yeah,
yeah, it is actually leading the euro currency, the euro dollar. It
right.
is leading.
Okay.
Why
Right.
is it? Why is it leading? It is because it is talking about this chart is the difference between the break-even rates in the US minus the break-even rates in the Eurozone. It means that if in the US the break-even rates increase, it means that the Federal Reserve has to do more to beat the inflation. If, however, the Federal Reserve uh, is not doing well against the inflation expectations, then this chart is going to rise. So in the last one month or 2 weeks, let's say 3 weeks, in the last 3 weeks, the market has decided that the Federal Reserve's actions are expected not to be enough to beat the inflation. And that is the reason why the euro has been rising against the dollar. Okay. And
not much.
Oh, not much, but it made a move. Yeah.
Okay. Yeah.
And looking at the well, I don't like to this technical charts, but the technical charts kind of are um, confirming that the euro dollar may move further to the upside. Maybe the highest is maybe, I don't know, maybe 109, but I do not think it is going to be more than that, because as you see, when the inflation data comes strong in the US, the Federal Reserve people are going to come up and talk about raising the interest rates further.
But today, today's number was a good number. It was lower than expected, right?
Yeah, I mean, I do not look at whether it's lower than expected or not. 4% is still very, very high inflation rate in the US.
Yes.
Given
Okay.
given that we are heading towards
a recession.
Recession, yes, yes. So that's why 4% is, I mean, 4% is really high. I mean, again, I personally do not look at the expectation, because expected data, where does it come from? We don't know. I mean, they're just expectations of other traders, but maybe they're found in the polls. But I look when I look at the market-based inflation expectations, such as this one, break even, it says to me that the Federal Reserve is not doing enough to protect the U.S. investors against inflation.
You think they're going to go tomorrow and surprise the market, and or are they going to pause and say that they're just going to evaluate, but they keep the door open for a hike in July? That's what the market's thinking.
Of course, they are going to keep the doors open, because they have to keep the doors open. Right. Otherwise, if you imagine that.
Why don't they just go today then?
To what?
Why don't they just tighten tomorrow? instead of waiting till July? Do you think they'll tighten Wednesday?
Yes, the reason why they are waiting is they want to see the economic data coming in and reflect on in the economy. That means, for example, we are talking about recession expectations. If there is recession expectations, and if it is true, then they might be thinking that one way or another, commodity prices are going to fall. So they're looking at the commodity prices, whether they're going to fall or not. If they're going to fall, then maybe they're going to say, let's not move too much and stay here where we are and wait further and wait and see what's going to happen.
Well, don't you think that crude collapsing 4% yesterday after a few cuts by the Saudis in the last 4 months, we're in the low 60s. Don't you think that's emblematic of they're already getting lower commodities? Grains have been killed, everything, copper.
The reason why they are cutting the production is because they are very well convinced that the recession is coming. So they don't want their commodity to fall. So that's the reason why. I mean, that is an indication.
It's not working.
Huh?
It's not working.
Well, it is not working because recession expectations are stronger. So if that's the reason why the Federal Reserve is going to decide not to be so decisive on what they're going to do next, but they are not going to say that this is it. We're not going to increase the rates any further. They cannot do that because you don't know where the inflation is coming. The inflation is maybe coming from the cost side, which in this case is the price of commodities. If that is the case, then it will be very complex for the Federal Reserve to make any decision. So I think they're going to have to wait for some time. They cannot say that's it. We are going to stop raising the interest rates. There's one more thing I want to share with you, Dale, about regarding the silver, because as you know, silver is a commodity, is as important as crude oil because it is used in the industry. So it is an industrial metal. If I share with you my silver page, look what I have here. Here on the screen, this white line, you see this white line is the convenience. This is the convenience yield of the silver. So the convenience yield is basically what it is telling you. It is how much the investors are willing to obtain and hold a commodity, a physical commodity. Here we see that. Here in this chart, we see that, as you can see, this silver convenience yield has fallen. This means that less and less businesses want to keep this metal in their backyards. They don't like to stock this metal. Well, this is a very good indication that the recession might be coming. But on the other hand, as you mentioned, because the Saudis are cutting the production, then the energy prices may fall. It creates an unknown about what the Federal Reserve is going to do. So the Federal Reserve is in the face of these unknowns. On one side, there are very strong signals that recession is coming, and on the other side, there are Saudis and other. I don't know. I mean, other energy prices are also increasing with the crude oil. So Federal Reserve is in between the inflationary and deflationary forces. So that's why they are not going to stop raising the interest rates. And let me share with you one more thing also with this regarding this chart you see on the page. On the screen. As you can see, this convenience yield chart has been leading the silver price over when you look from the longer term perspective. So the fact that this white line, which is a convenience yield, or 1 year convenience yield, has been falling for about 1.5 years or 2 years, whereas the price of the silver has been going up. Well, one way or another, the silver prices might be coming to
Lower?
around 22 area, 22, 21 area in the coming. And I see that the technical indicators are all the same sort of thing. That as you can see, for example, on the MACD chart, there's a sell signal going on, and the volatility is has been going down. So the volatility is going down means that there is a higher chance that a downward price pressure may happen soon in the next maybe one week or maybe maximum 2 weeks. So I expect the silver prices going down. That's the reason also why I expect the dollar to increase. And so one of your colleagues just said he short the euro. I think that's a correct position, I believe.
That was me.
That was you. Okay.
All right. Okay, some interesting looks and the kind of stuff we don't see much. Anything else on your mind you want to share with us today? Although you've been generous.
Sure. One other thing I've been looking at is this one. I just want to confirm with you. Do you have now a different chart here?
Yeah.
Okay. I have this one is the same analysis for the crude oil.
Okay.
This white line is showing us the convenience yield, the 1 year convenience yield of the crude oil. As you see in the last how many months? In the last one year, almost 6 months.
Wow. I mean,
that's
a perfect correlation.
Exactly. I mean, it should be, and this is basically indicating that the market is very much undecided, because on one hand, crude oil is being hit by the recession fears, and on the other hand, the OPEC Plus is cutting the production. So that's, I mean, this is so well visible on this chart. So the market is so much undecided. That's also true for the Fed. The Fed is looking at these kind of numbers, and they're saying that we don't know where the energy prices are going to go.
Yeah. Well, I do recall Paul saying that they didn't want to repeat the mistakes of the 70s, which was a stop and start monetary policy, where they thought they had inflation contained, only for it to reemerge a few other times during that decade. So veering from that path if he pauses here, because he doesn't know, and he's guessing that it may be enough. And your pause, I'm not sure if the pause, what's he going to know in a month? Anyway, just seems to be a different path than what he had laid out. And I don't think he's getting all the measurements he wanted for inflation. And, I mean, there's two things for housing. Housing prices are actually ticking up in many markets. And he got some decent news on the claims Thursday, but the NFP last month was strong. So why is he pausing?
So that's exactly. So on one hand,
you want to know why he's pausing? Because you and I could look at squiggly lines and formations and everything else, but there's a global banking crisis underway.
Really?
You don't think so? You think everything's okay?
Well, it depends on the asset prices.
They need a bond rally. So that would help their duration trade out. And that's what's going to be engineered, I think, here. So that's the pause, is to probably help give the banks a window to lighten up on their and get
Okay,
a
so
nice.
you're basically saying that the Federal Reserve is going to have to pause at some point because they don't want to overkill the economy, and plus they don't want to hurt the banks' bond
It's more
position.
about the banks. They don't care about the economy. The banks
Okay.
are their friends and allies,
Mm.
not the economy. It's all about the country club.
So then it's all about keeping the duration. I mean, they're focused on the duration of the banks'
They're
bond.
focused on that Janet Yellen said there'd be more consolidation in the banking industry, which is code for failures.
Oh,
So
well,
anyway, that's my take. And it's interesting that a pro like you isn't even thinking about it. And so who is? If you know, I bring it up and it's a surprise to people, yet we had major bank failures and everyone thinks things are okay.
well,
And
we
if you
had
look at,
sorry. I mean,
if you look at the,
we had a terrible banking crisis in 2008, but then everything recovered, right? So
oh
people
yeah,
say,
it recovered after, you know, most of America lost their homes. And it was a great break to buy for BlackRock to scoop up all the real estate and then rent to the people who used to own it. Yeah, it recovered, but there was sure a lot of pain before it recovered.
yeah, that's true. That's
And
true.
this is, I think, in even, you know, could be an even bigger banking problem here. It's global and it's about their books. Anyway, that's just my, you know, I'm a little bit.
No, you may be totally right. I mean, that's something that I haven't much
Yeah,
thought about. Yeah.
yeah. So we'll see. I think that would be the reason for a pause. Because if
Yeah.
he tightened the duration book looks worse. So maybe he'll give the market a few months to have a bond rally and 10-year comes down under 3% and they get bailed out on their positions a little bit. It's still way off from where it was a year and a half ago. So, but every bear market has bear market rallies. I don't think it's the beginning of a new bull market in bonds. Like
Of course, yeah, that's for sure.
Anyway, thanks for interviewing me today. Oh, I interviewed myself, didn't I? Anyway, I really like your work and what you're seeing currency wise and silver wise. Real different way to look at it than most, and kind of confirms what, you know, classical analysis is saying at the same time. So thanks for bringing that to the table, Okan,
Thank
and
you. I
rearranging
appreciate
your schedule to be here.
Thank you. Thank you, Dale.
Yeah, we have a
My
fixed
pleasure.
time, so I don't have flexibility with the time here, and I appreciate you, you know, finding a way to make it here and share your great work.
Thank you, Dale. Appreciate too.
Where do you want people to follow you on Twitter, or is there any place that we could send people that are interested in what you were talking about today?
Yeah, they can follow me on Twitter. I can put these charts on the Twitter, and they can study and look at it. And if they have any questions, I'd be more than happy to answer them and give them further insight about what I've been talking about.
Okay, so you could find Okan on Twitter. He uses his name as his handle. So it's at OKANAYBAR. And you'll know a little bit. I never even knew there was a convenience yield. So thanks for educating me today too, buddy.
Thank you. Thank you.
All right, everyone. Good luck the rest of the day. Okan, thank you. And good luck. You could join the team in about, I don't know, let's see, it's 19 minutes for the morning edge and keep up with what they're doing on this day. And this is just a warm up for tomorrow. So good hunting. Don't just count your pips, count your blessings, everyone. And I'll see you. Barry, I agree with you. Like 08, what was it? It was WU, Washington Mutual, and then it was Bear Stearns, and the moment didn't come until Lehman. So you're right. It could have a long lag. This thing could play out for quite a while. All right. That's a wrap. Adios, Warriors.